Your credit score is a lie. Well, not exactly a lie, but you're probably looking at the wrong number and wondering why banks keep rejecting you even though your credit score says 750. Here's what banks don't want you to know. There are actually dozens of different credit scores, and the one you see on Credit Karma or your banking app is probably not the one they're using to make decisions about your money. I'm about to break down the 2 credit scores that actually matter for getting approved and why understanding this difference could be worth hundreds of thousands of dollars for you. What's going on, family? My name is Stedman Waiters, and before I started my funding business, I was a guy checking my Credit Karma obsessively, wondering why my excellent credit score wasn't getting me approved for the credit I needed. Turns out I was looking at the wrong score the entire time. And once I learned what banks actually look at, everything changed. Not just for me, but for the hundreds of business owners I've helped access funding over the past 4 years. This isn't some complicated finance theory. This is practical information that can immediately improve your approval odds and potentially save you from making expensive mistakes. So let's dive into the credit score system that nobody talks about, but everyone should understand. Here's the problem. When most people think about credit scores, they think there's just one number. They think you either have good or bad credit, right? That's completely wrong. There are actually over 50 different scoring models being used by lenders today, but here's what matters. The vast majority of important financial decisions are made using just 2 of them, the FICO 8 and FICO 3. And here's where it gets confusing. That score you see on Credit Karma, that's called a VantageScore. Most credit monitoring apps use VantageScores because it's cheaper for them to access, but banks, they use your FICO scores to make their decisions. It's like studying for the wrong test and then wondering why you failed. You could have a 780 VantageScore and a 720 FICO score. When you're applying for that business loan, guess which one the bank cares about when you're applying for that business loan or credit card? This is why people get shocked when they apply for credit with what they think is excellent credit and get rejected or approved for way less than they expected. Let's start with FICO 8 because this is probably the most important credit score you never heard of. FICO 8 was introduced in 2009, and it's what most credit card companies and personal lenders use today. If you're applying for a credit card, personal loan, or most business credit cards, they're probably looking at your FICO 8 score. Here's what makes FICO 8 different and why you need to care about it. First difference, FICO 8 is more sensitive to high credit card balances. If you're carrying balances close to your credit limits, FICO 8 will punish you harder than any other scoring model. Second difference, FICO 8 completely ignores collections under $100. So that old medical bill for $75 that's been hunting your credit report, FICO 8 doesn't care about it. The third difference, FICO 8 is less forgiving of recent missed payments, but more forgiving of old ones. If you missed a payment 6 months ago, it'll hurt your FICO 8 score more than it would with other scoring models. But if you missed payments 3 years ago and have been perfect since, FICO 8 will give you more credit for your recent good behavior. The fourth difference, FICO 8 treats authorized user accounts differently. If you're an authorized user on someone else's account, FICO 8 is smarter about detecting whether that account is actually helping your credit profile or is it just artificial inflation. What does this mean for you? If you want to optimize for FICO 8, focus on keeping your credit card balances low, ideally under 10% of your limits, pay your bills on time consistently, and don't worry too much about small old collections. Now let's talk about FICO 3, which is actually part of a trio of scores that mortgage lenders use. When you apply for a mortgage, lenders typically pull your FICO 2, FICO 4, and FICO 5 scores from all 3 credit bureaus. Here's why FICO 3 and these older scores matter. If you ever want to buy real estate or refinance a property, these are the scores that determine whether you get approved and what interest rate you will pay. And here's the kicker. FICO 3 and the other mortgage scores can significantly differentiate from your FICO 8 score. I've seen people with FICO 8 scores in the 760s have FICO 3 scores in the 720s. That difference costs you thousands of dollars in high interest rates. Here's what makes FICO 3 different. Payment history weighs more heavily. While FICO 8 is 35% payment history, the older models like FICO 3 put even more emphasis on never missing payments. Credit utilization is calculated differently. FICO 3 looks at both individual card utilization, but it's not as sophisticated as FICO 8 in how it weighs these factors. Length of credit history matters more. FICO 3 gives more credit for older accounts, which is why mortgage lenders love to see long credit histories. New credit inquiries hurt more. FICO 3 is less forgiving of recent credit applications than FICO 8. Account types are weighted differently. FICO 3 gives more credit for having a mix of installment loans like car loans and revolving credit like credit cards. Understanding these two scoring models isn't just academic knowledge. It can literally save you or make you tens of thousands of dollars. Let me give you real life examples of why this matters. For credit cards and business funding, if you're trying to get approved for business credit cards or personal credit to fund your business, you need to optimize FICO 8. That means keeping your credit balances as low as possible before you apply. I've seen people get denied with 80% utilization and get approved a month later with 30% utilization, even though their VantageScore barely moved. If you're planning to buy real estate or refinance, you need to understand that mortgage lenders are looking at older FICO models. This means you might need to approach credit optimization differently. For mortgage scores, having a car loan or a personal loan that you're paying on time can actually help your score more than it does with FICO 8. For business decisions, if you're trying to get funding for your business, different lenders use different scores. Traditional banks often use FICO 8 for business credit cards, but they might use mortgage scores for SBA loans. Alternative lenders might use a completely different scoring model, but for the most part, they'll be using FICO 8. Here's the bottom line. If you're only paying attention to one credit score, you're flying blind. You might think you have excellent credit when lenders see you as average, or you might think your credit is worse than it actually is and miss out on opportunities. Now that you understand the difference, let me show you how to build both FICO 8 and FICO 3 strategically. For FICO 8 optimization, keep utilization extremely low. Aim for under 10% on individual cards and under 10% overall. If you're carrying balances, pay them down before the statement date closes, not just before the due date. Focus on recent payment history. FICO 8 cares more about your recent payment behavior rather than your history from years ago. If you had credit challenges in the past, consistent recent payments will help your FICO score recover. Don't worry about small collections. If your collections are under $100, FICO 8 ignores them completely. Focus your dispute efforts on larger items. Be strategic about authorized user accounts. FICO 8 is smart enough to detect artificial credit building, so make sure any authorized user accounts you're adding are legitimate relationships with real spending. For FICO 3 and mortgage score optimization, never miss payments ever. These older models are less forgiving of missed payments and put more weight on payment history overall. Keep old accounts open. Length of credit history matters more to FICO 3, so don't close your oldest credit cards even if you don't use them. Maintain a credit mix. Having both revolving credit and installment credit helps your FICO 3 score more than FICO 8. Be patient with new credit. FICO 3 is more sensitive to new credit inquiries, so space out your applications if you're planning to apply for a mortgage. Learn to pay down installment loans strategically. While paying off debt is generally good, paying off your only installment loan can actually hurt your FICO 3 score if it eliminates your credit mix and credit age. The universal strategies that help both scores are paying everything on time, every time. This is the foundation of all good credit scores. Payment history is the focus. Keep credit card balances low. Both models care about utilization, just in slightly different ways. Monitor all three credit reports. Errors can hurt your scoring model, so dispute inaccuracies quickly. Be strategic about credit applications. Only apply for credit you actually need and can qualify for. Here's how to actually monitor these scores without going crazy or spending a fortune. For FICO 8, many credit card companies now provide free FICO 8 scores to their customers. Chase, American Express, and several others show your FICO 8 score for free. You can also get your FICO 8 score through myfico.com. This requires a paid subscription. For FICO 3 and mortgage scores, these are harder to access for free. MyFICO.com offers mortgage score monitoring, but it's more expensive. Some mortgage lenders will show you these scores during the application process. You can also request them specifically when you're ready to apply for a mortgage. To be practical, focus on FICO 8 for day-to-day monitoring, since it's easier to access and use for most credit decisions. Then when you're planning to apply for a mortgage, get your mortgage scores pulled specifically. Don't obsess over checking your scores daily. Monthly monitoring is plenty, and the most important thing is understanding the behaviors that improve each type of score. Let me tell you about the mistakes I see people make all the time. Mistake number one, optimizing for the wrong score. People focus on improving their VantageScore because that's what they can see easily, but lenders are using FICO scores to make decisions. Mistake number two, treating all FICO scores the same. They assume that if their FICO 8 is good, all their FICO scores are good. That's not always true. Mistake number three, closing old accounts to clean up their credit report. This can hurt your FICO 3 score more than it helps. Mistake number 4, focusing only on their personal credit scores. If you're a business owner, you need to also understand business credit scores, which work completely different. Mistake number 5, thinking credit repair is a quick fix. Building good credit scores takes time and consistent behavior, regardless of which model you're optimizing for. Understanding FICO 8 and FICO 3 isn't just about having better credit scores, it's about having better financial opportunities. When you know what lenders are actually looking at, you can make smarter decisions about how to manage your credit. You can time your applications better, you can avoid costly mistakes that hurt your scores that actually matter. Most people spend years building what they think is good credit, only to find out they're optimizing for the wrong metrics. Don't be one of those people. The credit game has rules, but nobody teaches you what they are. Once you understand the rules, you can play to win instead of playing blind. If you found this video valuable and want more real credit and funding strategies that actually work, make sure you subscribe and hit the notification bell. I break down financial strategies that most people never learn in school or from their bank. Also, drop a comment and let me know, were you surprised to learn about these different scoring models, or was it something you already knew? Most people have no idea this system even exists. Until next time, remember, your credit score isn't just a number, it's the key to better financial opportunities, but only if you're looking at the right numbers. Peace.